On October 19th, U.S. 10-year yields touched 5% for the first time in 16 years. Now, the drivers of the move have been the subject of great debate. Some believe that the rise in yields is a signal that the market thinks the Fed will be able to keep rates higher for longer, while others think it may be the fear of returning inflation. Most analysts, however, agree that at least some part of the move is a direct result of increasing government issuance to meet spending without the previous advantage of having the Fed providing demand. But what happens if the Fed becomes concerned by the rapidity of the up move in yields or thinks that the absolute rate is higher than they're comfortable with? Well, some suggest that there could come a point where the Fed slows down its quantitative tightening policy or shifts back to quantitative easing. Now, the major concern here is that if the Fed begins buying bonds again, it could support the price of bonds, push yields lower, but could also risk diluting and devaluing the dollar, which just so happens to be what they've been fighting against. At current levels, the Fed seems confident in the path of yields, but slightly uncomfortable with how quickly they've arrived there. Any suggestion by the Fed that they may manually contain long-end rates could have massive implications in all markets, but particularly in bonds, equities, and metals.